You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. I have a great episode today. My name is Brady Weller. I'm joined by Itamar Novick from Recursive Ventures and Aaron Rosenson from Aption. Two folks who care a lot about founder liquidity, founder risk, have spent a long time in the venture world. Novick building a fund right now and investing in early stage businesses. And Aaron, who is helping founders diversify their position in their companies so that they can take on maybe a closer type of risk to all of their outside investors. And so trying to keep incentives aligned while also helping our founders live lives that, or comfortable lives that are maybe in line with the risks that they're taking over 7 years building a company. And so great to have you folks on, and we'd love to jump in and hear maybe tomorrow we can talk about your background briefly, and then we'll go to Aaron.
Yeah, I'd love to. First of all, Brady, thanks for having us. Really excited to be here today, and thanks for anybody out there that's listening to us. I think founder and also startup employee wealth and wealth creation and preservation are extremely important things to talk about. So I'm so happy to be here today. Just a quick background about me. So I've been in startups for my entire career, which is now almost 25 years. And I've been on all sides of the table. I'm a serial entrepreneur and startup exec. I've also been an angel investor and institutional VC. These days, I run a super early stage fund called Recursive Ventures that leads, pre-seed investment rounds in mostly data and AI companies. And we also do some seed deals. So we're doing $500,000 to $1 million check is sort of the average check size that we have. And we're truly, really founder focused in many ways, as you'll see, on this show, which is why I also wanted to highlight some of the things that we're going to talk about today with Aaron and talk about how VCs can proactively help founders with their own wealth creation and preservation.
Very cool. Yeah, Aaron, why don't you jump in and give us just a little bit of background? I know you came from, you had a stint in VC as well, had a lot of success there, and now you're building a little bit outside of that world.
Yeah. I, like Itamar, I was doing VC for a very long time, a number of years at Insight Partners, which is a leading growth stage private equity fund based out of New York, where I spent a lot of my time focusing in growth stage software. And after that, as a partner at Aleph, one of the leading early stage and seed stage funds in Israel, where understandably I spent a lot of my time focusing on early stage and seed stage. And after doing VC for over a decade, I was just very struck by the sacrifice and commitment and risk that a lot of founders were taking. And when I came across with a co-founder of mine, an opportunity to help solve part of that problem, a meaningful part in a way that didn't mess with the alignment that a founder needed to have with building a great company and being aligned with their VC, yet allowed them to be way safer and way well off, at least mathematically over a long period of time. That just felt like a really important gap to close. And so I picked up the mantle, maybe against my better judgment, and we've been working on Aption for a few years now.
Aaron, maybe we can define a little bit how you view the risks that founders take on. Like, when you say risk, is it like, well, this founder could have been working at Google and making $400,000 a year, but they're making 70 at their startup? Or do you mean more maybe like physical, like they're working 80 hours a week and not seeing their family, all of those things together? How do you define risk, and where do you maybe start drawing lines and saying, yes, this founder, the incentives are in line with other investors or other stakeholders, or maybe they're not aligned, or vice versa?
Yeah, I think that these are good questions, and I'll try to answer it in an accurate and nuanced way. I think that risk can mean a whole ton of things, ranging from personal, financial, not being able to make ends meet, all the way to the fact that ultimately we have a finite amount of time on this planet and we want to spend as much of it self-actualizing, being creative, being with people we love, building meaningful, lasting relationships, pursuing spiritual goals, whatever. And when you run a business, you are going to probably have less time on that than nearly everyone else doing anything else to try to make ends meet or make money. These are 60, 70, 80 hours a week. And the statistics are very clear across dramatic amounts of data points, number of companies, amounts of time. Most of these startups fail. Many of the ones that don't were not worth the time in hindsight. The missed dinners, the late night calls, the lack of vacations. And that's challenging. And that puts there are untold stories of all sorts of broken families, broken people, and issues that come with that. Now it's necessary to have an incredible amount of dedication to build a business. But the reality is that if the business works out, whether one had a little bit more or less ownership probably does not change so much the enjoyment and the well-being they're going to get out of life. But if it doesn't work out, that's going to tend to be pretty unfortunate. But if we could shift that, if we could take advantage of the dynamic and make it so that more people are going to have at least a respectable outcome, and maybe give up on the fact that instead of making $12 million, they're going to make 11.7 million instead, then that's something that could be just really, really good for everyone and powerful and protective. And so this is what I mean by sort of risk and I guess the opportunity around that.
And I can jump in as well, more from the VC perspective in that question. So like for us VCs, like I have a fund with 35 portfolio companies. Guess what? Statistically, one or two of them are going to, they're going to win. They're going to make it. And that means that, the money will flow back to my fund. It will flow back to my LPs, and I'm going to get my carry check, right? Like likely, if all goes well. It might be big, it might be small, but in a way, because of the built-in diversification that VC funds have, like for VCs, our journey is much more of a safer journey, right? I know that statistically we're going to be fine. Well, the individual founder that I back in my fund is actually not in that position at all. They're more likely to have sub 5%, again, I'm a pre-seed investor, sub 5% chance of actually, building significant wealth from the individual company that they're running. And they're doing it for 10, 15 years. So I think it's very important to explain that stark difference between, the VC position and the founder position and sort of the type of risk that they're taking on. And then again, if there are ways to minimize, mitigate, reduce that risk, then I think that's very smart, because at the end of the day, for me as a VC, I want my founders to make money. I want them to be successful. I want them to be motivated to honestly work even harder, of course, within the realm of reason. I don't want them to get a divorce because of this. But helping them make sure that they get compensated for all the time and hard effort that they're putting in becomes a priority for me. Because again, we want to be perfectly aligned with our founders. We want to make them rich. We want them to be rich because they've been successful. If the founders make it and they get rich, we get rich. Everybody's happy.
Yeah. So what are maybe some of the levers that you can pull there? And then we'll talk about Aption and some of the vehicles that you guys have to de-risk founders in these situations. But what are some of the other levers? I mean, I can think of some really obvious ones, like VCs being a little bit more salary friendly. Like if there are caps on executive comp or founder comp, those being maybe a little bit less oppressive, depending on the stage of the company. What are some other levers? Am I off basis even in thinking about that one? What would you, because you don't want to say, well, we really want to position this company and position the founder so that they don't have to work 80 hours a week. Time is a tough one, because sometimes you do have to work 80 hours a week. Sometimes you have to work 90. Sometimes you work 30. I don't know. So what are some of the levers as you see it?
I'll jump in and let Aaron go after me to cover more of what Aption does, and because I think that's a perfect fit on giving you more options. But as a VC, here's what I actively do to help my founders make the most out of their startup journey from a financial standpoint. One is I've started talking publicly about things like, hey, maybe early stage investors should not have preferred shares, right? Maybe it's okay for us to have common. That means that if it doesn't work as well and there's, a fire sale or more of a downside in the startup, it didn't work well, because there isn't a big preference stack, potentially founders could walk away from more. So I'm encouraging that obviously I can't change the entire market. The market runs on preferred shares, right? But the minimum we can do on our end is to educate founders about what it means and educate them about what's in those term sheets to make sure that they're making the right choices for them, for their financial future. So that's one. The second thing is my really superpower at Recursive Ventures, and my founders know this, is I'm the guy that gets my companies funded in the next round, right? I sit down, I build the decks with my founders, narratives, everything. I make most of the intros for most of my companies. I've actually helped over 50 of my companies raise this Series A and beyond, and I've raised over $500 million myself in every stage, right, as a founder. When I work with my founders on negotiating that deal for your Series A with the VCs, I do it with the lens looking at the founders and the employees. How do we make sure that we properly help them, mentor them to negotiate these term sheets and these definitive agreements that come in the Series A and beyond to make sure that we're maximizing the opportunity for the founders and for the employees? Because that's what I care about. I care about the team that actually builds this product. I want them to be happy. I want them to, reach their financial goals and dreams if this thing works out. So I am hands-on helping my founders negotiate those deals with VCs, being on the founder side, right? And that's what I actively do to support that. But again, that's not enough. And I'll hand it over to Aaron so he can talk about, Aption and some of the other options that are out there.
Yeah, let's pause on the common preferred thing just a sec. Preferred is the bane of many founders' existence, especially in the situation where you said where there's a fire sale, or they have to draw down the assets. It might actually, the business might have failed for a reason completely irrelevant to what the founding team did or what the team itself did.
That's actually what happens most of the time, to be clear.
Yeah, exactly. So a shift in the market, some kind of regulatory change. Any number of things. And so, I think a lot of times you hear, this is market. This is, you're looking at documents and you're looking at terms. You're saying, this is market. So maybe attorneys will say, or other VCs will say, how do you start that conversation when you have someone sitting across the table and they're shrugging their shoulders and say, these are the way we do deals?
Yeah. So, look, there are a lot of nuances and a lot of terms in a definitive agreement in an investment, right? Mm-hmm. And there are different levers and you can negotiate different things. So I'm not saying that I don't want to set the expectation with founders that they're going to come to an institutional Series A and they're going to get away from giving out preferred shares.
Sure.
They're not going to give out preferred shares. Yeah. It's a question of, what are the terms on that? How does the drag along look like? Is it a 1x regular preferred, or is it, participating? Yeah. There's so many nuances and there's so many tricks and games that VCs do and founders need to be aware of, which is why I started a series of quote unquote VC horror stories. Just follow me on LinkedIn at Ilmar Novik, at LinkedIn. There's only one, so you'll find me. And you'll see I've now done 112 posts. I just checked. 112 posts on what I call VC horror stories, which is situations where, VCs could be trying to push terms down the founder's throat, which are debatable, right? I'm not, you don't necessarily have to agree to some of those terms, right? So what I'm really trying to do is I'm trying to really educate founders on what's important, where they should push back, and how to push back. Because the answer is not, no, I'm not doing preferred. The answer is, well, what type of preferred? What are the terms? The devil is in the details.
Yeah, Aaron, founder could have raised a ton of money and have a really handsome valuation and have a successful underlying business that's growing rapidly, and still be sharing, a 2-bedroom place with 4 people, maybe they're co-founders, and have no real access to the value that they've generated. Start talking a little bit about what options exist around founder liquidity, maybe aside from secondary and some of the other obvious, maybe quote unquote more obvious ways that you could get liquidity from your position. And then you can introduce sort of what you guys are working on.
Yeah. And I think that honestly, the scariest part, just on the first part of that, is that it's not even that the founders, these people can't access, it's that they can't protect it. because while Itamar is doing a C stage is important and he's forward thinking on it, what's really scary is that a company can be exciting for 9 years and then be worth nothing. And the folks who've spent their whole 20s, 30s, early 40s, or some other whatever 15-year slug doing this, and then all of a sudden have everything evaporate before they've been able to protect any of the 5, 10, 50 million of paper wealth they have, that's who it's really most devastating, because they've given up half of the prime of their career at this point. And so,
an analogy here, right? Like if I have $10 million of equity in my company on paper,
you see,
right?
whatever.
Yeah. And I'm, grinding towards that versus say I have $10 million in like a public equities portfolio. There are ways like with long shorts and different kinds of structures that I can actually hedge the downside in my equities portfolio. That doesn't exist at all for paper wealth, the way that like with the ease in which we can protect, say,
the Great Depression that goes through 2008, and you're going to still walk away with that stuff if you don't sell. But a lot of times that 10 here goes to zero, and that's
zero. Exactly. Yeah.
And what's unfortunate is like you said, there is cash liquidity that plays an important part in this ecosystem, especially as IPOs get pushed up more and more. But increasingly, it isn't enough for a variety of reasons. It's a very limited market. Only a certain very small subsegment of companies have access to it. And many companies that have real meaningful value and whose founders and owners have real meaningful stakes in those companies don't have access to those cash secondary markets either at all or at levels that are sufficient for them to best protect themselves and their families. So what we've gone and done and said is, look, the safest place to be is diversified. The big golden rule of is, diversification is the only free lunch. And that's why we've had tens of thousands of people be able to enter the middle class or middle class to upper class because of John Bogle and folks like that who popularized mutual funds, index funds, broad-based baskets. Now, founders don't get to have that. They have a single company. It's probably not going to work out mathematically. Even at the late stages, it's still very unlikely to work out, which is even scarier. And so the question in our mind is, how can we make their risk profile look a little bit like the people who hold diversified baskets without taking away from the hard work and their dedication to their business? You can't diversify your way out of hard work, and you're going to still care financially and emotionally about your business at a great level. And so what we did at Aption is and we're not the first to think of this idea, but we think we are the first to build a really thorough and thoughtful solution for it. We've found a way to enable founders and other equity holders too, to diversify in a cash-free, a cashless way, a small portion of their equity. And so if you had a $8 million position in a business that you've been building for 7 years, we would enable you to take $500,000, $1 million of that and put it in a sort of pool, an equity pool, we call it, with a dozen other founders with similarly promising positions. And so now if regardless of how your business works out, you have this, approximately $1 million position in a dozen other interesting companies, it's probably going to be worth, $1.5 to $2 million by the time all is said and done. And the benefit there is, even if your company is part of the vast majority that doesn't work out, you have money to put down a down payment on a house, to help your kid be in the place so they can go to, law school or college or whatever is going on. Who knows what's going to be going on with college with everything going on these days. But point being, this money means a lot more at the low mid six figure or even low seven figure standpoint than it does between high seven and like low 8 figure. And oftentimes as a founder, the trade-off is taking away a little bit there to make sure that you have something there on the upside. So it's just kind of this utility shifting, this Econ 101. And we could do that now. And that's really exciting for all founders out there who are trying to do what's rational and safe and protective.
Yeah. How would you define the risk profile of the pooled vehicle? So this you take, maybe you said like 10%, it would be like maybe 10% of your paper value, and it goes into this pooled vehicle. And there's maybe, is it a couple dozen other companies that you have then access to, or what does that look like?
We have different. We right now have close to 24 pools, and we have pools that have high double digits to pools that have single digits of members. And I think the risk profile of the pool varies greatly by the type of pool it is. Our pools can be build your own, choose your own with governance by the members. Our pools can be done programmatically. So we have one pool that is just the top 24 companies in Israel right now, multi-$100 million recurring revenue, elite pre-IPO businesses. And that pool is very not risky, so to speak. As in, somebody can go with one of the best companies in the world, look at that pool and say, wow, having a bit of that pool is actually more exciting to me than owning more of this great company that I'm owning. And we have another pool that's for companies that might have raised from Tiger in 2021, where it's a good company, but it's a big pref stack. And who knows when and if it'll ever see liquidity, if it gets over the pref stack or not. And that pool is a lot riskier. But what's a lot riskier than that is keeping 3 million of your 3.2 million net worth in that company that was funded by Tiger at a $3 billion valuation when it only has 50 million of revenue. And so diversification makes everyone safer as long as it's similarly promising companies, which it tends to be for a variety of reasons. But each pool is going to have a different risk profile because it's kind of going to tend to reflect the quality of the asset going into the pool.
So how does the pool acquire the interest, the new interest? What capital is used to acquire the interest that gets actually put into the pool from, say, the late stage growth company?
So the beauty of this whole transaction for founders and equity holders is that it's cash free. So people are contributing their equity in kind into a pool. And even the only fee we take is a little bit of the equity on the way out. So we're not seeing any cash from that position on an exit, at least until they're seeing an exit in most circumstances. So, and so a pool gets built and somebody agrees to contribute the equity or economics of their equity to the pool. And so we can come to someone and they can say, I like the idea, but I don't like this company. And then we come to them later and they say, wow, this is an interesting business. That's an interesting business. They also raised from good investors recently, or they also are in a segment, or I know them, respect them. And yeah, I'm in. And so we sign a couple contracts. These are contracts that we've spent a huge amount of time, efforts, and resources building to make sure that they are airtight, that they protect capital gain stream, and that they accomplish all the fine print stuff you'd want it to accomplish. And people are in at that point. And now they have
basically swaps. You're basically swapping.
Yeah, without getting into the exact detail of how we're doing it, we can go low level with anyone and their accountants.
Yeah, and when I say swap, I don't mean it's
trading. It's like everyone's kind of tossing some equity into the pool, and they now basically have like a VC portfolio that they own.
Sure. Yep.
And going to get paid out like VCs. It's going to be smoother. It's going to be likely, more frequent, sooner, with a higher degree of likelihood of not being zero.
Yeah, very cool. Itamar, I know that Aaron and his team are, or you're on their cap table. I mean, so I should say, Recursive is that correct? What sort of taking in context your philosophy and how you're trying to maximize outcomes for founders and build a better environment for founders to build alongside VC and to push the boundaries for innovation. What was the initial the problem set, and then the specific solution that Aaron just described that drew you to their company?
Yeah. So here's what actually made me invest in Aaron and his team at Aption, and why I really believe in this. Other than obviously everything that I said about, I think it is beneficial for everybody in the ecosystem to collectively improve outcomes in terms of wealth creation and management for founders. So when I was running my previous company, Life360, we were kind of like, we raised a lot of money, hundreds of millions of dollars, obviously in preferred. And we, the founding team has always been very conservative and okay, this is going great, but what happens if it hits a wall? And I think for me, it was very clear, just to give you a sense, because I've done 182 investments in my career across institutional, late-stage VC, incubation, angel investments, Recursive Ventures 1 to 3, which I run now, 182 investments. And I can tell you, and this is good data, that so far, only 7 companies have actually driven cash into investors and founders' hands so far in a significant
way. He's passed 10,000 or 20,000 others, and he's really good at his job too. And so these are the daily choices that made it over the line with a 1% acceptance rate. It's just really freaking hard as a founder.
Yeah. And it's also because I'm a pre-seed investor. So I invested in inception.
Sure.
And guess what? The odds of success at inception, even if you're really good, I already said it's sub 5%. So knowing all that, when I was running Life360, we're kind of well, this is a high risk game. Why don't we do this? And basically we took 9 other of our friends, other companies, which we admired, amazing companies that did well. We really loved their product. And we said, okay, if we're going to go to our respective boards and say, oh gosh, we want to diversify across this all 10 companies, they're going to hate it. They're going to shoot it down. So instead, we all signed each other as advisors in each company. I'm not kidding. And we genuinely helped each other with advice. We were already actively advising all these other companies, and they were actively advising us, and we're doing business deals together. So it made a lot of sense. But then at the back of that, we also saw the opportunity for diversification. And it actually worked out. I won't name specific names, but one of the founders that we did this deal with actually had a significant exit before our exit. Life360 is now an $8 billion publicly traded company. So we're obviously got to a very good point at the end, but it took 18 years. On the way, that other company that we swapped with actually sold for over $1 billion. And we got early, one, and two, this diversification. As a benefit, we actually got the money and everybody was super happy. And guess what? When my company IPO'd later on, Life360, that other founder, he was also very happy. So basically, we were replicating what Aption was doing manually in sort of a very, half-assed way. And then Aption came along, and I was like, wow, this is perfect. I have to invest in this thing. And that's how it came about.
Very cool. I love that you were doing a half-baked, or maybe it worked, so it wasn't half-baked, totally half-baked, but a half-baked solution to what Aaron and his team are doing now, and then have actually productized it. It's really cool. Here in our last couple of minutes here, something we talk about a lot on the podcast is actually even just weighing, and we have current VC and former VC on right now, is actually weighing what's your perspective on the moment at which founders need to determine, how do I capitalize this new business? And do we fully go the most traditional VC route? Do we raise debt? Do we do other types of financing? Do we try and bootstrap this business? What do we want out of the business? That moment in the founder journey where they're trying to determine those things, what advice do you give founders that you would say is founder friendly with respect to that moment in time where they're making those types of decisions? That's
an excellent question. I'll jump in because I think I do this very often, and Aaron did it less because he was more of a late stage in Series A VC. I get a lot of oh, well, we're getting started. 2 women and a dog in a garage. Should we be venture backed or not? So I'll jump in. At the end of the day, if you want to really dumb it down to one thing, the question you should be asking yourself as a founder is this thing VC scale, right? And VC scale means that you have a clear understanding that the total addressable market that you can eventually tap into is in the multi-billion. It's not 1 billion. It's multi-billion. This is a huge market. It's a huge opportunity. And because it's so big, it justifies taking equity capital upfront, right? And investing ahead of time to go grab that market share. Go do that R&D. Go do all the things that you wouldn't have been able to organically build, because then you wouldn't have the same outcome. Organically build would not get you the finish line on a $5 billion business without venture. And I think this is an important point that a lot of founders still get wrong. The issue is, if this is not a VC scale, if this is not a VC backable business, and you take VC money, what inevitably would happen is you would get misaligned with your VCs because they did it to get the $5 billion exit. And you actually did it knowing that it's only a $500 million business. So the VCs and the founders are misaligned at that point in time, and it could end badly, right? It could end with, board wars and preferred shares pulling all sorts of crazy stuff on you. And you never know, right? Because you're misaligned. So, there's others, but that is the fundamental question. Is this big enough to warrant taking money that you don't have ahead of time to build something so big that will do so much value creation and that warrants VCs? And let me tell you, most businesses are not eligible for this. Most businesses should not be VC backed. And founders still make that mistake. They still raise VC money, even though it shouldn't be VC money. And I think they should be more careful, not to protect VCs. I don't care about that. I care about protecting themselves, because if a founder can build a business, and I don't like the term lifestyle business. The lifestyle business is, sorry for my French, is a bullshit phrase. If you have a business as a founder that you produces $2 million a year in dividends to your pocket, that is an amazing business. And I don't care how it's called, right? And you can do that without any VC money and be very successful, and you'll be very happy with what you have, right? And like having bad connotations around, oh, this is a lifestyle business. It's wrong. It's just wrong. A business is a business. Every business matters. Every business should be respected. Many of them should not be VC backed. Some should, and that's the ones that we should be focused on.
Yeah, many VCs use lifestyle business as like a jab or some kind of derogatory term, but every founder I know who has a successful lifestyle business and is doing what you said, distributing $2 million to their pocket each year, I think is very happy with the outcome.
They don't need VCs on their board. They don't need all this bullshit. They don't need it doesn't make sense for that type of a business, and that's perfectly okay.
I think that I know we're at time. I think that the pejorative use of that term is reflective of some of the underlying cultural issues that stop founders from acting as rationally as possible while being respectful of VCs, and that it's easy to call something a lifestyle business, where as a VC you have contracted management fees and a portfolio of 50 to 60 companies, a dozen of which have broken out. Similarly, it's easy to say, go big or go home, go for the glory, be an everlasting name, in the American economy or whatever. It's easy to say that when that is your business model, to go for those specific sorts of businesses alone. Actually, in reality, if you have a little bit of downside protection, you can really swing for the fences, take that risk that reduces runway to unlock more growth. But that's outside the scope of this count, really. I think that we need a culture shift overall. And I think that actually is going to lead to wins for VCs and founders. It starts with making founders safer, and that's going to enhance alignment.
Yeah, and VCs have 10 to 15 years for their fund to pan out, and founders have like 4 years. In terms of like the feedback loop, I guess is what I mean, right? It's like founder can go from, hey, this was a huge bust between year 1 and year 4, and the VC still has a bunch of chips on the table, and they,
Brady, I wish it took 4 years. Honestly, a 4-year vesting came about because of that, because, either it works or it doesn't. We now have companies that go for, I don't want to name names, but I know companies that were exciting for the entire 2010s and now are dead in the water, and people, gave over too much time to it. And, it's a real problem for people. It needs to be a better solution.
And some of that problem is out of their control because it really depends on the economic cycles. Is there an IPO window open? Is there not? Guess what? There's no IPO window open. 5 years goes by and this company is no longer a hot, company, and they can't IPO. So like a lot of this stuff is outside of the founder's control, which is a key piece here that I think Aaron emphasized. And like, you could do all the right things as a founder and still walk away with nothing, even though it has nothing to do with what you did.
And you get to a point of no return too if you get to Series O and the IPO window hasn't opened and you diluted yourselves to death, and you have to get to that kind of outcome in order to recognize a gain. Like there is a point of no return once you've raised a certain amount of money that you kind of have to IPO or else you might wash out.
People don't even know what those limits are. Everyone said you get 100 million ARR as a software company, you're safe. It's all good to go. I know a software company started in the late 2000s, not even 2010. They're at 120, 140 million. Tier 1 board members, world-class VC, that said, you know what? You're not going so fast, but it's SaaS, it's recurring, good net dollar retention. You just keep adding, keep stacking. AI came out and their business model is obsolete after 15
years. Yeah.
And the founders there, people that were worth tens of millions, if not more, and single millions on paper, it's going to be worthless for them now. And if they had been able to do an equity pool, they'd be able to have, house money, maybe retirement money by now. And they would have still been working just as hard on the freaking business for the last 15 years. But it's just, humility. The world is a crazy fast moving place, and so much has to go right for these businesses to work out.
What's even the secondary, most of the founders that we work with at our business are taking secondary. And I'm really glad to see a lot of really excellent founders building exciting businesses, being able to take money off the table at A and at B, have done it consecutively. And we work with a lot of these founders. But I also know that, your investors can sometimes make it really challenging to take that $1, $2, $3, $4, $5 million off the table during those rounds. But I think there needs to be a more founder-friendly approach there. If you're building the type of company that could reach the scale and the outcome that you guys are talking about, which is like, hey, venture-backed, we want a $1, $2, $3, $4, $5 billion exit, them taking $2 million off the table during Series A or B isn't demotivating at all. The goal is $1 billion exit. Not that sort of $1 million liquidity, but it does help them to put down roots in the area where they have an HQ, maybe send their kid to a school that they don't have to worry about other things in their life.
Absolutely. I can tell you from firsthand experience, and I'm very supportive of founders getting secondaries to a certain tune and at the right stages, right? It's not something that you would do the pre-seed. It's something that you would do when you know you have a business and it's growing and it's doing very, very well. And there is over demand for an equity route. That's that's the typical setup. But as a person who has done 3 secondaries, personally, right? I can tell you that, and not just, by the way, as CFO, I also ran a secondary process to all employees in our company that had 5 years or more in the company. We had liquidity for everybody that really worked hard all those years when we had the money, when we had the demand. And I can tell you that every time we did it, and we did it 2 times for the team, twice for the team, if I recall correctly. It just made everybody more motivated. It made them push harder. We kind of almost moved the goalpost up, which is a good thing because now our people are more ambitious. They want to get more done. And it is part of what made our journey at Life360 eventually end up with an $8 billion publicly traded company, because and there are people in Life360 who have been there for a decade and got this liquidity. And guess what? They're working even harder because they could go back to their homes. They could go back to their family and say, this thing is paying off. I know you said this is a very early stage, it's risky, startup, blah, blah, blah. Here you go. We're actually starting to make money on this thing.
Yeah, it's actual feedback.
Motivated.
Yeah, it's actual feedback, right? It's like, okay, I just put 4 or 5 years into this thing. I know all the value that we create and what we've done and all the sweat equity and everything that we put into this. And oh, look, now I actually have tangible feedback on this thing was valuable. It's not just on paper. So yeah, certainly it's ridiculous that someone could try and posit that in and of itself is demotivating. That's like maybe the exact fuel that someone needs. Get that feedback and keep pushing, like you said.
And that is also exactly why I guide my founders in negotiating terms to unblock future secondary transactions. And just a shameless plug, I have multiple posts on LinkedIn specifically regarding how you can increase the odds of you not getting blocked on secondaries by your board and preferred shareholders. So that's what we actively do.
Yeah, you both have provided a ton of really good insight on, just generally stepping back to rethink founder risk, founder liquidity. What are the options here? How can we diversify in the midst of building a startup? All those things that we haven't got to talk about on this podcast yet. And I think you guys do a great job. So appreciate you coming on. Maybe just briefly, obviously we can find you tomorrow at LinkedIn. Ton of posts you can go on and read. He has a good following there. Follow along with his journey at Recursive. And Aaron, what's the best way for folks to get in touch with you?
Yeah, email, LinkedIn, or website. I'm Aaron Rosenson. You can find me on LinkedIn, on email, aaron@aption.com. That's Aaron at Aption. Aption is like option, but with an A at the front. Because we have this kind of new security. It's not a stock. It's not an option. It's an Aption. This way of diversifying with each other. Aaron@aption.com. And of course, our website is Aption.com as well. So if you want to, at any point, understand more about this solution and how it could fit into your life, or you think you know people who could benefit from hearing about or using something like this, reach out at any time. We'd be happy to share more and help you integrate it into your worldview and try to be helpful.
That's awesome. Yeah, thank you both. We'll hopefully talk again soon.
Yeah, thank you, Brady.
Okay. Thanks for having us.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.